So double A, audit and assurance. This is our second lecture. In first lecture, we have covered chapter 1. In chapter 1, we have covered what is audit. We have covered different terminologies used in audit, like what is test of control, what is substantive procedures, difference between interim and final audit, walkthrough test. We have covered a concept of materiality. We have covered what is meant by true and fair. And we have covered non-audit engagements. We have covered different types of assurance. We covered assurance engagement and its 5 elements. So today's lecture, we're gonna discuss 2 chapters, one chapter 2 and chapter 3. Chapter 2 is a small chapter. So let's discuss this chapter first. The name of the chapter is a statutory audit, or you can say regulations. What is meant by regulations? What is meant by regulations? Laws, rules, policies. For auditing profession, we are going to study regulations, mean laws, policies, standards regarding auditing profession. Mean auditing profession, mean being auditor, we need to follow some laws, some rules, some standards. Why the regulations, mean laws, have been defined for auditing profession? What could be the reason? If there are no laws, what will be the issues? Mean why laws, mean regulations have been defined for the auditing profession? To control the auditing profession, so that auditors should be controlled, so that all the auditors should work in the same manner, same way, mean to achieve harmonization, mean to control and to achieve harmonization. What is meant by harmonization? Same. Everything should be same. Mean every auditor should work in the same manner, in the same way. Or there was some corporate failure in the past. So to avoid corporate failure or scandals, there were some corporate scandals, corporate failures in the past, and to avoid those failures or scandals, regulations have been defined for the auditing profession. And out of those failure or scandal, there was a big scandal called Enron case. Have anyone of you heard about the Enron scandal? Enron. Okay, let's discuss what was the Enron scandal. Enron was a very big, very large multinational organization in the USA. And this organization normally deals with energy. I mean, they produce energy and sell to the public. What happened in 2002? While preparing financial statements of the Enron company, directors made a fraud. What was a fraud? They omit $7 billion liability from the financial statements. Meanwhile, preparing financial statements, director omitted $7 billion liability from the financial statements. Mean they didn't show the $7 billion liability in the financial statement. Mean company bought some asset on loan leases basis. And if you have bought any asset on a leases, what you need to do, you need to state assets as well as the liability, both things. They stated the asset in the financial statements, but they omitted 7 billion liability from the financial statement. Why? What could be the purpose of omitting liability from the financial statement? To show strong financial position. What is balance sheet? Statement of financial position. If there are more assets, less liability, this means company financial position will be strong. And if company financial position is strong, investors will be attracted to the company. And if more investors are attracting to the company share price will go up. So in 2002, while preparing financial statements, director omitted 7 billion liability from the financial statements, mean they showed asset but not the liabilities. And Enron auditor was Arthur Anderson. Mean there were a audit firm called Arthur Anderson. At that time, there were big 5 audit firms. Nowadays, there are big 4 audit firms. What are the big 4 audit firms? PwC, Price Waterhouse and Cooper, Deloitte, EY, Ernst and Young, and KPMG. KPMG. Nowadays, there are big 4 audit firms. Big 4 mean these are the top 4 audit firms. PwC, Price Waterhouse and Cooper, Deloitte, Ernst and Young, and KPMG. At that time, when this scandal was happened, this fraud was happened, there were big 5 audit firms. The fifth biggest audit firm was Arthur Anderson as well. What happened in 2002? While preparing financial statements, Enron company director made a fraud. They omitted 7 billion liability from the financial statements. And while auditing the financial statements, Arthur Anderson, their auditors, they issued a report in favor of the company, mean they said financial statements give true and fair view and are prepared according to accounting standards. Arthur Anderson mean their auditors knew there is a fraud in the financial statements, but they involved themselves with the fraud as well, mean they issue audit report in favor of the company. Mean they were involved with the fraud as well. What happened? When company financial statements were published in the public along with the audit report in favor of the company, the investors started to buy company shares at high price because company financial position is strong, share price went up, and investors started to invest in the company, means started to buy shares of the company. And when banks saw the financial statements of Enron company, they saw company have shown the asset but not the loan, mean lease liability of $7 billion. They highlighted this fraud. And after highlighting the fraud, it made public the news coming in the newspaper, in news channel. So investor knew there is a fraud in company financial statements. So they try to withdraw their investment. And by withdrawing their investment, if there is a sale of asset, there was no demand, means supply of asset shares were there, but there was no demand. So company share price went down to $1. From where? From $250 to $1. And after that, government suspended the trade of company shares because it was a very big company in USA. So government were involved. Some investigation found that directors made a fraud of 7 billion liability omission from the financial statements. And investigation found that Arthur Anderson, the biggest audit firm, were also involved in the fraud. Since then, Arthur Anderson licenses cancelled all over the world. Means this firm demolished all over the world. And now we are having big 4 firms. So why auditing regulation has been defined to control the auditing profession, to achieve harmonization so that every auditor should work on same manners, and to avoid corporate failure scandals like Enron, so that these kind of scandals should not be happened again, because this scandal have affect the repute of the auditors as well. Because if auditors are involving in the fraud, then shareholder to whom they can rely to give him the report, to give him the audit report, whether financial statements are true and fair or not. So these are the three main reasons why regulations have been defined. There are three types of regulations, mean how auditing profession can be regulated. There are three types of regulation. One is called self-regulation, other is called independent regulation. What is self-regulation? Self-regulation means the country government will govern the auditing profession. Self-regulation means auditing profession will be regulated, will be governed, will be monitored by the country government. Mean every country government will govern, will regulate the auditing profession working in the country. How? By defining different country laws. In fact, country government have approved a body. Every country is having a auditing body. Like in UK, the auditing body is ACCA ICW. In India, the auditing body is Institute of Chartered Accountants in India. In USA, the auditing body is CPA. In Canada, the auditing body is CPA Canada. In Australia, the auditing body is CPA India, CPA Australia. So every country has defined a body that will govern, that will regulate the auditing profession. So if auditing profession is regulated through government or government defined body, that is called self-regulation. What is independent regulation? Every body is governing their members. Like if ACCA is a body, all the ACCA members working around the world as accountant, as auditor, who will regulate them? The ACCA body itself. Obviously, government will also govern. ACCA body will also govern. If ACCA body is governing its member all around the world, that will be called independent regulation. Because in some countries, the government working very honestly and they govern, they monitor profession in best practice. While in some countries, the government is corrupt himself. So they are unable to govern the auditing profession properly. If suppose ACCA members working in different countries, in some countries they are governed properly by the government, while in other countries they are not properly governed by the countries. So ACCA has decided, no, I will govern my members by myself. If ACCA is governing, is defining rules for their members working all over the world, so that will be called independent regulation. And the third type of regulation is called international regulation. What is international regulation? Where is international regulation? This should be called international regulation. There is an organization in USA called IFAC, International Federation of Accountants. International Federation of Accountants. IFAC is a not-for-profit, non-governmental USA-based organization, not-for-profit, non-governmental USA-based organization who agreed with all the accountancy body around the world. Like if we are working as accountant auditor on different multinational companies and the companies are having their offices in different parts of the world, then our regulation should not be self mean country to country government, or should not be independent mean body wise. We should follow the same level of rules, same level of standards. Like accountancy should be done as per IAS, IFRS, International Accounting Standard, International Financial Reporting Standards. In the similar manner, auditing profession should be regulated using international standard called AISAs. ISAs stands for International Standard on Auditing. What is IAS? International Accounting Standards. IFRS, International Financial Reporting Standards, while ISA stands for International Standards on Auditing. This body is defining international standards that every auditor, wherever they are working, to whom body they are member, either they are member of CPA, either they are member of ACCA, either they are member of ICAI, they should follow the same level standards, international standards. And if auditing, regulation, monitoring is done through international standards, that will be called international regulation. There are some boards working under IFAC. One board name is IASB, International Accounting Standard Board. International Accounting Standard Board role is to issue IAS or the new accounting standard name becoming IFRS. The old accounting standards name is IAS, International Accounting Standard, while the new accounting standard name is IFRS, International Financial Reporting Standards. Being accountant, we cannot do accounting by our own wishes. We have to do accounting as per standards. In the similar manner, if being an auditor, we are working as an auditor, we cannot do anything by our wishes. We have to conduct audit as per ISAs. There is another board working under IFAC called IAASB. What is the name of our paper? AA stands for Audit and Assurance. IAASB stands for International Audit and Assurance Standard Board, whose role is to issue ISAs. ISA stands for International Standard on Auditing. So auditing profession can be regulated in three ways. First is called self-regulation, according to country government. Every country government will define some rules to monitor auditing profession. Independent regulation body wise, your body to whom you are member, either ACCA, ICW, CPA, they will govern you. They will define rules for you. What is international regulation? Under IFAC, being accountant, you have to follow IAS, IFRS, and being auditor, you have to follow ISAs. Everything auditor will do, it will be done as per ISAs. We cannot do anything according to our personal wishes. How to perform test of control, how to perform substantive procedure, these standards ISAs will define. They will tell us you can perform test of control like this, you can perform substantive procedure like this. So what is IFAC? International Federation of Accountants. And under IFAC, there are two boards working, IASB, International Accounting Standard Board, whose role is to issue IAS, IFRS. And other board working under IFAC, that is called IAASB, International Audit and Assurance Standard Board, whose role is to issue ISAs. How ISA can be issued? Procedure for issuing ISAs. How ISA can be issued? There is a procedure to issue ISAs. Not there. Let's discuss. Who issue the standard? ISA. Who issue the ISAs? IAASB. So what happened? IAASB first issue exposure draft for public comments. Before defining any auditing standard, the board IASB issue exposure draft. What is exposure draft? Raw form of standards that has not been finalized yet. They write some rules relating to the standard and send to different accountancy body, to different firms to get their recommendation. like we are going to define this standard. These are the rules of the standard. Please recommend if there is anything to add in it, if there is anything to delete from it, or if there is anything that need amendments. So board issue exposure draft for public comments mean taking public comments, public recommendations, and after the public comments, the exposure draft will be back to the board. And as per the public comments, after making necessary adjustments, they issue mean finalize ISA. Now auditor have to follow this ISA. So what is the procedure for issuing auditing standards? IASB issued exposure draft first for public comments. And after the public comments, that exposure draft will return back to IASB. And as per public comments, after necessary adjustments in the rules, they issue mean they finalize a standard. Now this standard have to be followed by the auditors. So what we have discussed, why auditing regulations have been defined. There are three types of regulations. International regulation is through IFAC. IFAC is defining international standard that auditors have to follow, accountant has to follow. What is the procedure for issuing a ISA that we have discussed? Now we are moving towards the second part of this chapter, in which we need to discuss appointment of auditor. We need to discuss qualification of auditor. We need to discuss removal of auditor. We need to discuss resignation of auditor. And we need to discuss about rights and powers of auditors. And we need to discuss about duties of auditor. So forehead, we need to discuss appointment of auditor. Who appoint the auditors? Who appoint the auditor? Shareholder. Auditor appointment is at the AGM. Mean an auditor is appointed at AGM. AGM stands for annual general meeting. Every company must have an annual general meeting once in a year where they present financial statements to the shareholder. So at AGM, shareholder appoint the auditor, and if auditor is appointed at an AGM, he will be auditor for the until the next AGM. On the next AGM, the auditor will be reappointed, either the similar or shareholder will appoint another new auditor. Mean what is the time period for auditor appointment? What is the tenure of auditor appointment? That is 1 year. Mean auditor is appointed at one AGM and he will be the auditor for till next AGM. On next AGM, shareholder have to reappoint either this auditor or they can change, mean they can appoint a new auditor. So shareholder can appoint auditor. And they have to appoint the auditor through majority shareholder voting. What is majority shareholder voting? What is majority shareholder voting? More than 50% or 75%, that will be called special resolution. Directors can appoint auditor. Directors can appoint auditor, but only first auditor. After that, all auditor appointments should be through shareholder. So directors can appoint the auditor, but only the first auditor. After that, all appointment of auditor should be made by the shareholder. Our director can appoint auditor to fill casual vacancy. To fill casual vacancy. What is casual vacancy? If during the year your auditor has resigned, this means auditor office is vacant. So that vacant office is called casual vacancy, and to fill the casual vacancy, directors can appoint the auditor within 14 days. If they unable to appoint auditor within 14 days, then shareholder will appoint the auditor. So when directors can appoint the auditor, first auditor, directors can appoint. I mean, after incorporation of the company, after birth of the company, the first auditor, directors can appoint. Or directors can appoint auditor to fill casual vacancy within 14 days. Otherwise, all auditor appointments should be through majority shareholder voting. If directors and shareholder both fail to appoint the auditor, in that case, commission will appoint the auditor. What is commission? Commission means stock exchange. Who will decide remuneration of the auditor? The party who is appointing the auditor. If shareholder are appointing the auditor, they will decide its remuneration. If directors appointing first auditor are filling casual vacancy to appoint the auditor, they will decide its remuneration. But if commission means stock exchange appointing the auditor, in case they both fail to appoint the auditor, in that case, stock exchange will define the remuneration. I mean, who is appointing the auditor, they will decide remuneration of the auditor. Is that fine? What is meant by qualification of auditor? Auditor must be qualified. Qualified mean must be member of recognized supervisory body. RSB stands for recognized supervisory body. Every country government define a recognized supervisory body that will govern auditing profession in the country. Like in India, the RSB is Institute of Chartered Accountants in India. In UK, the RSB is ACCA or ICAW. In America, the RSB is CPA. So to become an auditor, to work as auditor, to sign audit report in the country, you should be a member of that country recognized supervisory body like ACCA or ICAW in UK. An auditor become disqualified. An auditor become disqualified if he is a shareholder of the company to whom he is going to audit, if he is a partner, officer, or employee of the company to whom he is going to audit, or he is a employee of any partner or officer of the company. Even though he is a member of body, but if he is going to audit a company to whom he is a shareholder, he is a partner, he is officer, he's an employee or employee of partner or officer, he will be considered legally disqualified, mean he cannot conduct audit of that company. Is that fine? So we have discussed about appointment of auditor, who can appoint auditor, and when auditor will be appointed, and what is going to be a qualification of auditor. Now we are moving towards who can remove the auditor. Auditor can be removed by only shareholder. Again with majority shareholder voting. Directors cannot remove the auditor. They can appoint first auditor or to fill casual vacancy, but they cannot remove the auditor. Who can remove the auditor? Only the shareholder. Directors cannot remove the auditor. They have no authority to remove the auditor. Why? Because auditor have to check the work of directors. And if they have to check the work of directors, so they should not be under threat of directors, like they can remove him. If shareholder are going to remove the auditor, they have to send a notice period to the auditor. So that auditor should be aware he is going to be removed. If auditor consider his removal is not fair, if auditor consider his removal is not fair, he has a right to write a statement of circumstances. In which he will state why they are going to remove him. If he consider his removal is not fair, he has a right to write a statement of circumstances in which he will mention all the reason why he is going to be removed, the mean why his removal is unfair. And this statement of circumstances should also be seen by the next auditor. And he will decide according to the statement circumstances whether he should accept the audit of this company or not. Because if they removed unfairly previous auditor, they can remove the new auditor unfairly as well. So who can remove the auditor? Only shareholder with majority shareholder voting. Directors cannot remove the auditor. And while removing the auditor, company management shareholder should send a notice period to the auditor. And if auditor feel his removal is unfair, he has a right to write a statement of circumstances in which he will provide all the reasons, all the circumstances why he is going to be removed. Not only he should write the statement of circumstances, auditor should submit this statement of circumstances to registrar of the company as well as to its body, professional body like ACCA as well. So that they should also be aware why auditor has been removed either fairly or unfairly. During service, auditor can resign from his service as well. Why auditor will resign? If auditor has decided to resign from a company, why he will resign? Why he will resign? Online students, if auditor decided to resign from a company audit, why he will resign? Personal reason, any clash with company management? Or might be he is working as auditor, but he got an offer to become officer of the company at a very high salary. So either he can conduct audit or either he can join as officer. If he decided to join as officer, he will resign from the audit. because he will not be independent. If during audit, auditor knew that he don't have enough resources to conduct the audit, he has a right to resign. So if auditor has decided to resign, he should submit his resignation to the company with the notice period, so that company can appoint another new auditor with that notice period. And while resigning, it is a duty of auditor to write a written statement called statement of circumstances. Mean at the time of removal, he is having a right that he can avail to write a statement of circumstances, while at the time of resignation, it is his duty to write this statement of circumstances. Mean he should mention in this statement why he is resigning. If there are no circumstances, he will write statement of no circumstances, but it is his duty. At the time of resignation, if he feels I should speak the matter to the shareholder why I'm resigning, he has a right to call EGM. EGM stands for Extraordinary General Meeting. Give me 2 minutes, please. So at the time of resignation, auditor should submit his resignation with a notice period. He has a duty to write statement of circumstances, and he has a right to call EGM. EGM stands for Extraordinary General Meeting. Extraordinary General Meeting. There are two types of meetings in a company. One is called AGM, Annual General Meeting, that is compulsory, must be held once in a year. And his purpose is predefined to present financial statements to the shareholder. And if company need to call other meetings of shareholder, that will be called extraordinary general meeting. These are not compulsory. These are for any specific purpose. If auditor feels he should communicate the reason of resignation directly to the shareholder, so he has a right to call EGM extraordinary general meeting, where he will communicate to the shareholder why he is resigning if there is any clashes between auditor and company management. Is that fine? So we have discussed about appointment of auditor, about qualification of auditor, about removal of auditor, resignation of auditor. Now we are moving towards what are the rights and powers of auditors. Auditor has a right to access all records of company for audit purpose. For audit purpose, he can take access to all records of the company. Company management cannot. They are not providing right. Or not having he can sign. It's his right. Auditor have a right or power. Why? To require Peter has a right to require all information for audit purpose. He can ask anything from company management, from company staff, from company accounts department staff for audit purpose. Company staff, company management cannot deny to provide any information to the auditor. It is his right. Auditor has the right for AGM. He can receive notice period. Notice period mean invitation. Meanwhile, sending invitation of AGM to shareholder, company management should send it to the auditor as well. He has a right. He has a right to attend AGM. And he has a right to speak at the AGM. Both AGM where he is going to be appointed and till next AGM, he has a right to receive notice period of AGM. He has a right to attend the AGM and he has a right to speak at the AGM relating to auditing matters. At the time of removal, he has a right to write a statement of circumstances if he consider his removal is not fair. At the time of resignation, he has a right to call EGM, ordinary general meeting, to consider he should communicate the matter to shareholder. What are the rights and powers of auditors? To access all records of the company for audit purpose, to require any information for audit purpose. For AGM, he has a right to receive notice period, to attend the AGM and to speak at the AGM. He has a right to write statement of circumstances at the time of removal if he consider his removal is unfair. And at the time of resignation, he has a right to call EGM if he want to speak matter to the shareholder directly. What are the duties of auditor? What are the duties of auditor? His main duty is to express opinion on financial statements, whether financial statements give true and fair view or not, and are prepared according to accounting standards. His duty is to comply with ISAs, Mean all the audit work he has to perform as per international standard on auditing. His duty is to comply with codes of ethics. Mean there are some codes of ethics that he need to comply. What are those codes of ethics? We will learn in chapter 5. His duty is to check whether company has maintained books of accounts. Books of accounts mean ledgers from where they are preparing financial statements. So his duty is to check whether company has maintained books of accounts. His duty is to confirm financial statements prepared as per books of accounts, maintained books of accounts. What are the duties of auditor? To express opinion on the financial statements, to comply with international standard on auditings, to comply with codes of ethics, to check whether company has maintained books of accounts, to confirm financial statements prepared as per books of accounts, and at the time of resignation, his duty is to write statement of circumstances. At resignation. Because at the time of removal, he has a right to write this statement of circumstances, but at the time of resignation, it is his duty to must write statement of circumstances. So this chapter has ended now. Chapter 2, finish. Question number 3. Even don't need to cover these questions because you will face MCQs from this chapter. So let's move towards chapter 3. Now we are moving towards chapter 3. What is the name of chapter 3? Chapter 3 name is corporate governance. Chapter 3 name is corporate governance. What is meant by corporate governance? Probably you people have studied this in BT. What is corporate governance? Corporate governance means the system by which companies are directed and controlled. The system by which companies are directed and controlled. System means rules. System means rules or codes. Corporate governance means certain rules, certain codes through which companies can be directed and controlled. Mean by following those rules, those codes, company can be directed, company can be controlled, company can be run in best manner. For every listed company, it is compulsory that they should follow corporate governance, mean they should follow certain rules, certain systems, certain codes. Where companies are listed? Where companies are normally listed? On a stock exchange. So who will define corporate governance codes? Stock exchange. Who will define corporate governance? Stock exchange. Stock exchange will define. Being a listed on stock exchange, you have to follow these rules. And those rules are called corporate governance. So what is corporate governance? The system by which companies are directed and controlled. Why? Why company have to follow these codes? To protect the investment of shareholders. To protect the investment of shareholders. If company is following certain rules, mean company is following rules defined by the stock exchange, so shareholder will be having a confidence like their investment is secure, their investment is protected in the company, mean they can make more investment. If company is not following any rules, so shareholder investment will not be protected, they will be under threat, might be our investment lost from this company. So by following the rules of stock exchange, mean corporate governance, shareholder will be having a confidence that their investment is secure in the company. Mean compliance of corporate governance codes will provide a confidence to the shareholder like their investment is protected, is secure. Not only shareholder, the other purpose to ensure the interest of other stakeholders. There are some other stakeholders who are attached with the company for their interest. And if company following corporate governance mean rules system by the stock exchange, other stakeholder will also having a confidence like their interest is ensured in the company, company will provide their benefit as well. Because these rules will govern, will direct the company. If you make a decision like this by following these rules, you can consider best for all the stakeholders. So what is the purpose of corporate governance? Mean these two are the purposes of corporate governance. If companies are following corporate governance, this will provide a confidence to the shareholder like their investment is secure in the company. And this will provide a confidence to other stakeholder like a company is ensuring their interest as well. What are the other stakeholders? Creditors, managers, employees, suppliers, customer, local community, government. So what is corporate governance? A system by which companies are directed and controlled. Why? To protect the investment of shareholders and to ensure interest of other stakeholders. Now we need to learn these rules, these system, these codes. Because in exam question, examiner will provide us a scenario and he will ask what are the deficiencies where companies is not following corporate governance. To identify deficiencies, we must know what are the rules that company need to follow. Who define corporate governance codes? Stock exchange. Every country is having their own stock exchange. This means these codes could be different from country to country. And to learn these corporate governance codes, we must learn corporate governance codes of any stock exchange. As we are studying UK syllabus, ACCA is based from UK. So we are going to study UK stock exchange corporate governance codes. And UK stock exchange corporate governance codes called UK combined codes of corporate governance. In the UK stock exchange corporate governance codes called UK combined codes of corporate governance. Mean what happened in the past in UK, different reports were issued relating to different rules of corporate governance. In one report, there were 4 rules defined. And when after certain time period, there was some problem in the industry, so they defined some new rules in different report. After some period, they defined some more rules in different reports, and all those reports of different rules have been combined together and named them UK combined codes of corporate governance. So now we are moving towards learning corporate governance rules. What are the rules that company need to follow? Before learning about those rules, we must be familiar about the structure of the company. In a company, there is a chairman. Under chairman, there is a CEO, and under CEO, there is board. Board stands for BOD stands for board of directors. And in board of directors, there are two types of directors. EDs stands for executive directors, and NEDs stands for non-executive directors. So in a company, there is a chairman. Under chairman, there is a CEO, and under CEO, there are board of directors. And in board of directors, there are two types of directors. One is called executive directors and other is called non-executive directors. What is the difference between executive directors and non-executive directors? What is the difference between executive and non-executive directors? Non-executive directors are independent. So what about executive directors? Executive directors are full-time employee of the company. And they are involved in day-to-day running of operation. While non-executive directors are part-timer, that's why the employee word is not associated with non-executive directors. And they are involved in a strategy making of the company. They are involved in planning of the company. So they are involved in strategy making or planning of the company, mean making a decision for the company. They are not involved in day-to-day operation of the business. They are only involved in strategy making, planning, and decision making. These executive directors pay include fixed salary as well as performance related pay like bonus. And to achieve that bonus, they have to meet certain targets. What could be those targets? Like if company profit increase by this percentage, you will get this bonus. If company sale will grow by this percentage, you will get this bonus. And to achieve their bonus, they sometimes involve in short-termism self-interest strategies. Who? Executive directors. So what are executive directors? They are full-time employee of the company. They are involved in day-to-day operation of the business. And due to bonus element in their remuneration, they sometimes involve in short-termism self-interest strategies. While for the company, short-term strategies are not beneficial for the company, long-term strategies are more beneficial. So what are non-executive directors? They are part-timer. They are involved in strategy making, planning, decision of the company, and they challenge short-termism strategies of executive directors. Mean this is not best for the company. You need to make this long-term strategy. And in non-executive salary, they work on hourly pay. There is no bonus element in their salary, in their remuneration. They work on hourly basis pay. I mean, how many hours they are contributing to the company, they will be paid like that. There is no fixed salary. Fixed salary is for full-time people, not for the part-time. Part-time receive hourly rate. So we have differentiated between executive and non-executive directors. In a company, there is a chairman, there is a CEO, there are board of directors, and board of directors are having two types of directors, executive directors and non-executive directors. Now we are moving toward discussing corporate governance codes. The first code, corporate governance code says non-executive directors should be independent. According to corporate governance codes, non-executive directors should be independent. What does it mean by independent? Except their hourly pay, they shouldn't have any interest associated with the company. Mean they shouldn't have any personal interest with the company. They should not be shareholder of the company. Because if they are shareholder as well as non-executive director, they will consider best for the shareholder rather than best for the company. I mean, they should be independent so that they should consider best for the company. If they will be shareholder, they will be considering best for shareholder rather than best for the company. Isn't that shareholder best and company best is same? Or is there any difference? If they are shareholder, what they will try? They will try that company should distribute all the profit as a dividend to shareholder. But for a company to face uncertain future events, some part of profit should be kept as a reserve. Mean they will not prefer the reserve policy of the company. That's why they should not be shareholder to maintain their independence. They should not be employee of the company. Not only current, even in the last 5 years, they should not be employee of the company. Because if they are employee of the company, they will consider best for the employee rather than best for the company. Not only current, in last 5 years, they should not be employee of the company. Otherwise, they will not be independent. They shouldn't have any trading relationship with the company. Not only current, even in the last 3 years, they shouldn't have any trading relationship with the company. Trading relationship means they should not be supplier, they should not be customer of the company. Otherwise, they will consider their best rather than company best. Because they are involved in strategy making, decision making, planning of the company. They shouldn't have close relation, either family or friendly, with executive directors. Because if they are having any family relation or close friendly relation with executive directors, they will not challenge their short-termism self-interest strategies. Mean they will not be independent. So non-executive directors should be independent. They should not be shareholder. They should not be employee in last 5 years. They shouldn't have trading relation in last 3 years, and they shouldn't have close relationship with the executive directors. So first code of corporate governance is that non-executive director should be independent. Second code, according to corporate governance code, board should be balanced. Meaning there should be at least half of the directors must be non-executive directors. Board should be balanced, mean at least half directors of the company should be non-executive directors. If company is having 8 directors, how many should be non-executive? 4. If company is having 7 directors, how many should be non-executive? Again, 4. At least half. Mean more than executive director is better, but they should not be less than executive directors. Why? While making a decision, executive both, non-executive both made the decision. If executive directors are more, their hands will be more. How board make a decision? By voting. If there are more votes towards a decision, that decision will be finalized. If there are less votes towards a decision, that will not be finalized. And if executive directors are more in number, obviously the board member have to accept the short-termism self-interest strategies. Mean their short-termism strategies will not be challenged properly. So to challenge the short-term strategies of executive directors, at least a half director should be non-executive directors. Otherwise, executive directors' short-termism, self-interest strategies will not be properly challenged. If there will be more in a number, they can challenge their short-termism strategies properly. So first code, non-executive director should be independent. And the second code, at least a half director should be non-executive directors. Now we are moving towards the third code. According to corporate governance code, the chairman and CEO should be separate person. One person should not be having two top position of the company of chairman and CEO. They should be separate person. For a chairman, he should be independent non-executive director. The CEO, Chief Executive Officer, is also called Managing Director. The name of CEO is Managing Director. He is normally a leader of executive directors. So according to corporate governance code, chairman and CEO should be separate person. If they are having same person at both position, chairman and CEO, he will be having his dominance in the company. And due to dominance, his decision will not be challenged by any other person. And if his decision is not challenged by any other person, he can run the company in his personal interest, in his best interest rather than interest of the company. That's why these two top positions should be of different positions. And it is mandatory for chairman, he should be independent non-executive director. Even their role are different. Chairman role is to run the board. Board means board of directors. He need to make sure whether executive, non-executive director both involved in the decision, whether non-executive director actually challenging short-termism strategies of executive directors. There is no clash between executive and non-executive directors. While CEO role is to run the company. To run the company means to manage day-to-day operation of the business. And he is a leader of executive directors in managing day-to-day operation of the business. So as their role are different, so these two persons should also be different. If one person is having both position, normally he will be executive directors. In that case, executive directors' dominance will be higher, will be more. And if their dominance will be more, then company will be involved in short-termism self-interest strategies, mean they will not consider best for the company. So we have learned three codes. Non-executive director should be independent, mean these things should not be associated with the non-executive directors. At least half of the directors should be independent non-executive directors. And chairman and CEO should be separate person to avoid dominance of any single person. And for chairman, it is necessary he should be independent non-executive director, mean who is the leader of non-executive director, chairman, who is the leader of executive directors, CEO. Fourth code. According to corporate governance code, the executive director should be reappointed or re-elected or retired every 3 years. Executive directors, including CEO, they should be appointed for 3 years only, mean their contract should be for 3 years. After 3 years, they will be retired. Company will see if they are performing better, they should be reappointed, re-elected. Otherwise, they can be removed after 3 years. Mean through this, company can achieve performance of the executive directors. Like if any director is not performing properly, you can remove after 3 years without any redundancy payment. In executive directors contract should be for 3 years. After 3 years, they will retire, mean their contract will be cancelled. Company will see if they are performing properly, they will be reappointed, mean re-elected by shareholder voting at the AGM. If they are not performing well, company can remove. Our company can afford maximum for 3 years a non-performing executive director. Can you understand this? So first code, non-executive director should be independent. Second, there should at least half non-executive directors. Third, chairman CEO should be separate person. Fourth, executive director should be reappointed every 3 years. Now we are moving towards fourth code. Board. Fourth. Okay, fifth. Board should meet regularly. Mean directors meeting should be on regular basis. Regular basis mean not once in a year, not twice in a year. There should be every month meetings, so that they can decide the direction of the company, so that they should be aware of how we are managing the company. And those meetings should be formal, mean in written form. Minutes of the meeting should be recorded. Minutes mean what they have discussed in the meeting. The recording, written recording of that meeting is called minutes. So that if any director is absent at the meeting, he should be aware through minutes of what the decision have been made at the meeting, what the discussion have been made at the meeting. And meeting should be according to agenda. What is agenda? Purpose of the meeting should be decided first, so that every director is coming to the meeting is having mind, okay, we're gonna discuss this matter in the meeting. We're gonna decide this matter in the meeting. If there is no agenda, they are not aware why the meeting is called. If they are not aware, the decision will be made on further prolonged meetings. So board should meet regularly. Meeting should be formal. Minutes of the meeting should be recorded for absent members, and agenda purpose of the meeting should be predefined. According to corporate governance codes, directors should implement internal control system in the business. What they should implement? Internal control system in the company. What is internal control system? Policies, procedures, rules they should define in the company. Why? To prevent, detect fraud and errors. Who is responsible for implementing internal control system? Directors. Not only they should implement, directors should review internal control system at least once in a year. What? Internal control system. And they should report to the shareholder like we have reviewed the internal control system. If there are any weaknesses in the internal control system they have found, they should state how they gonna remove these weaknesses in the future. So according to corporate governance code, directors should implement internal control system in the company. And at least once in a year, mean annually, they should review internal control system. If they are unable to review by themselves, they should appoint internal auditor. What is the role of internal auditor? To review internal control system. But internal auditor is not mandatory. If director can review internal control system by themselves, there is no need for internal auditor. But it's recommended, it's better they should appoint internal auditor, a separate person whose role is to review internal control system on regular basis. But internal auditor is not compulsory. If there is internal auditor, it's better. If no internal auditor, director have to review internal control system by themselves. If there is internal auditor, he will review internal control system. So there are two types of auditor, external auditor and internal auditor. Who is external auditor? Who is expressing opinion on the financial statement? Who is internal auditor? Employee of the company. Who appoint internal auditor? Company management mean directors. Why? To review internal control system if they are unable to review by themselves. So according to corporate governance code, non-executive director should be independent. At least half non-executive directors. Chairman, CEO should be separate person. Executive director should be reappointed every 3 years. Board should meet regularly. Director should implement internal control system. Director should review internal control system either by themselves or by appointing internal auditor. Let's take a 15 minutes break. After break, we will discuss some more codes of corporate governance and then we will move towards exam level questions from KIT. So coming back after 15 minutes, yeah. There. So we were discussing corporate governance codes. Non-executive director should be independent. Chairman, CEO should be separate person. At least half director should be independent non-executive directors. Executive director should be reappointed every 3 years. Board should meet on regular basis. Director should implement internal control system, and director should review at least annually internal control system and report to the shareholder. And it's better they should have internal auditor. They should appoint internal auditor to review internal control system. Now moving towards further corporate governance codes. According to corporate governance codes, there should be 4 types of board committees in the company. There should be 4 types of board committees in the company. What are those committees? Nomination committee, remuneration committee, audit committee, and risk committee. Nomination committee, remuneration committee, audit committee, and risk committee. Who should be the members of these committees? The members of nomination committee and risk committee could be either executive directors, non-executive directors, but should be majority of non-executive directors. So the members of nomination and risk committee should be majority non-executive director. Majority mean if company is having 5 members, how many should be non-executive directors? 3. Out of 5, how many should be non-executive directors? 3. If company is having 6 members, how many should be non-executive directors? 4, majority. But the members of remuneration committee and audit committee should all be 100% non-executive directors. Executive directors should not be member of remuneration and audit committee. Why? We will discuss later on. So according to corporate governance, there should be 4 types of board committees of directors. Nomination committee, remuneration committee, audit committee, and risk committee. And the members of nomination and risk committee should be majority of non-executive directors, while the members of remuneration and audit committee should be all non-executive directors. These 3 committees are compulsory, must be there. Risk committee is optional. If it is there, better. If there is no risk committee, his role must be performed. Then who will perform risk committee role? Audit committee. Now we are going to discuss what are their roles. The role of nomination committee is to appoint, reappoint, or remove directors. Who will appoint, reappoint, or remove directors? Shareholder. But nomination committee will provide recommendation to the shareholder which director should be reappointed after 3 years and which director should be removed after 3 years. If during the year any director resign, who will appoint the new director? Nomination committee. The role of nomination committee is to balance the board. Balance the board means if there are 5 executive directors while 3 non-executive directors, the board is not balanced. Who will appoint a new non-executive director to balance the board? Nomination committee. Their members should be executive, non-executive, both, but majority non-executive so that independent appointment can be made. If executives are more, they will appoint a yes man to strengthen their position. So to make independent decision, majority of the members should be non-executive directors. Executive directors should be included in nomination committee because to appoint any executive directors, only executive directors can assess his skills appropriately because they are working as a full-time in operation. So it shouldn't be of all non-executive directors. Executive directors should be part of nomination committee. But to make independent appointment, majority of the members should be non-executive directors. What's the role of remuneration committee? Remuneration committee role is to define remuneration policy of the company. Is to define remuneration policy of the company. Which director will receive how much pay? Which manager employee will receive how much pay? What are the benefits should be provided to the employees, managers, directors? Who will decide? 100% non-executive directors remuneration committee. So that the pay is mainly decided for the managers, employees, and executive directors. And they should not be involved in deciding their own remuneration. That's why the remuneration policy should be independent. How it can be independent? If it is defined by 100% non-executive directors remuneration committee. Who will decide remuneration of non-executive directors? There is no debate on non-executive director pay because they receive hourly rate. And that hourly rate is as per industry average. There is debate why executive director receiving these facilities, why managers, employees receiving these facilities, accommodation, car, helicopter, jet. So they will not be involved in deciding their remuneration. What's the role of audit committee? The role of audit committee is to oversee financial matters of the company. Is to oversee financial matters of the company. They review financial statements, whether they are prepared as per accounting standards or not. They review internal control system, whether it is working effectively or not. They review. Please. Audit committee role is to oversee financial matters of the company. They review financial statements, whether financial statements are prepared as per accounting standards. They review internal control system, whether internal control system is working effectively or not. And they review financial strategies or financial policies of the company. Who prepare these financial strategies, financial policies? Finance director. And normally finance director is an executive director. That's why audit committee members should all be 100% non-executive directors. If executive director is a member of audit committee, they will be reviewing their financial strategies, their financial policies, and that will not be independent review. So to make independent review, their all members should be non-executive directors. Audit committee role is to monitor what? Quality of work and independence of both internal auditor and external auditor. whether internal auditor, external auditor working properly, mean their work quality is okay, and they are independent. Who will ensure this? Non-executive directors audit committee. Audit committee role is to provide recommendation to shareholder regarding appointment, reappointment, removal, and fee of external auditor. Who appoint the external auditor? Shareholder. Who will reappoint the external auditor? Shareholder. Who will remove the external auditor? Shareholder. But shareholder are normally not aware of auditing firms. Who will help them regarding appointment of good auditor? Non-executive directors audit committee. They will provide recommendation to shareholder. Okay, this firm is good. They are having best repute. You should appoint them as auditor. This audit firm has done better in past. You should reappoint them. No, this auditor haven't performed well in the past. You should remove them. Okay, this auditor is performing well and this much should be his fee. Please approve that. Though shareholder appoint the auditor, but who will help the shareholder in appointing auditor? 100% non-executive directors audit committee. So what are the role of audit committee? To oversee financial matters of the company. They review financial statements, they review internal control system, they review financial strategies, financial policies of finance director. They monitor quality of work and independence of both internal and external auditor. And they provide recommendation to shareholder regarding appointment, reappointment, removal, and fee of external auditor. What is the role of risk committee? The role of risk committee is to define risk management strategy of the company. What is the risk management strategy? To identify risk, to prioritize the risk, to control risk, and to monitor risk. The role of risk committee is to define risk management strategy of the company, mean how business risk can be managed. What is risk management strategy? They have to identify what business risk company is going to face in the future on proactive basis. They should prioritize the risk, mean which risk will affect the company more and which risk will affect the company less. So that the more affecting risk should be monitored on regular basis. They should control the risk, mean define different policies, how risk can be controlled. And they should monitor the policies for controlling risk, whether they are working appropriately or not. Risk committee is optional. If this risk committee is not there, who will define risk management strategy? The audit committee, along with executive directors, because this committee member should be majority of non-executive directors. Why majority non-executive director? So that independent risk management strategy can be defined. So according to corporate governance codes, non-executive director should be independent. Chairman, CEO should be separate person. At least half directors should be non-executive directors. Executive director should be reappointed every 3 years. Board should meet regular basis. Board should implement internal control system. Board should appoint internal auditor to review internal control system. And there should be 4 types of committees: nomination committee to appoint, reappoint, remove executive directors; remuneration to define independent remuneration policy; Audit committee to oversee financial matters, and risk committee to define risk management strategy of the company. This chapter is completed except one small topic. We have covered corporate governance codes of UK Stock Exchange. And UK Stock Exchange corporate governance codes named UK Combined Codes of Corporate Governance. We have learned so many policies. There are some corporate governance codes defined by an organization called OECD. OECD stands for Organization for Economic Cooperation and Development. Organization for Economic Cooperation and Development. They have defined a minimum corporate governance codes requirement. Only 4 codes that every company must follow. Even these minimum corporate governance codes help different stock exchange while defining their corporate governance codes. What are the OECD 4 corporate governance codes? Rights of shareholder, mean company should provide rights to the shareholder regarding their voting rights. Equitable treatment of all shareholders, mean company should treat all the shareholders equally. Meanwhile, paying dividend, they should pay dividend to all the shareholders. While inviting on AGM, they should invite all the shareholders. Disclosure and transparency. While preparing financial statements, company management should provide some disclosure, and those disclosures should be transparent. There shouldn't be any hidden things. And responsibility of board. The company performance is on board of directors. If company made any loss due to any employee, directors cannot say that this loss is due to that employee. No, they should be responsible for that loss. Why? Shareholder has given the company to directors to manage it. Either they can manage themselves or they can manage appointing any employees. So while appointing any employees, they should assess their skills, whether they are capable of working properly or not. If there is any loss, who is responsible? Directors as a whole. If there is any profit, who is responsible? Directors as a whole. They cannot shift their responsibility to any employees. So these are the 4 minimum corporate governance code requirement. So this chapter 3 has ended. If you have listened to my lecture carefully, there is no need to read this chapter. Now we are moving towards some exam level questions from these chapters. So this is our BPP kit. In this BPP kit, let's move towards our question 65. Can you answer the 65 question? Indicate which of the following statements are true. Which of the following statements are true regarding regulation of the audit profession? Number 1, the auditor has the right of access to books, records, and vouchers of the company. True. The auditor has the right to be heard at general meetings on matter relating to the audit. Yes, he can speak at the general meeting. He has a right. The auditor is appointed by and answerable to those charged with the governance of the company. Those charged with governance is a term used for top level management of the company. Who should appoint the auditor? Shareholder. He is answerable to shareholder because his audit report is to shareholder. The auditor can be removed by simple oral resolution in line with the common law. No, through special resolution. Special resolution means more than 75% voting. So this is false as well. Is it fine? Okay, now moving towards question number 11. For question 11 to 15, we are having a scenario. For question 11 to 15, we are having a scenario. The following scenario relate to question 11 to 15. You are an audit manager of Satsuma and Company and have been assigned to the audit of Tangerine, tech company Tangerine, a company which is planning to list on a stock exchange within 6 months. Mean you are audit manager in this audit firm and this is your client Tangerine. And this Tangerine company is going to be listed on a stock exchange in 6 months. Obviously, after listing, they need to follow corporate governance codes. Because for every listed company, they have to follow stock exchange rules, mean corporate governance codes. The listing rule of stock exchange require compliance with corporate governance principles. And the directors are unsure whether they are following best practice in relation to this. I mean, they are not sure whether we are following rules of corporate governance or not. If they are not following, we can highlight for them. They have asked the audit engagement partner for their review on this matter. I mean, they have asked the auditor, please help us where we are not following the corporate governance codes, please recommend us. Tangerine board is comprised of 6 executive directors, a non-executive chairman, and 3 other non-executive directors. Is there any issue? There are 6 executive and only 3 non-executive. They should appoint at least 3 new non-executive directors to balance the board. You know, board is not balanced. The chair and one of chairman and one of the non-executive director are former directors of Tangerine. No, they should not be employee of the company even in last 5 years. So this is also the issue. They are not independent. And on reaching retirement age were asked to take on non-executive roles. The company has established an audit committee and all non-executive directors are members, including the chairman. No, the company chairman should not be the chairman of any committee. If a chairman is of the company, or every committee should also have their leader. And that leader will be called chairman of the committee. Either any person is a chairman of the company or chairman of any committee, he should be independent non-executive director. Executive directors cannot be chairman of the company or chairman of the committee. Who chairs the committee? All 4 members of audit committee were previously involved in sale and production related roles. What is the role of a audit committee? To oversee financial matters. So audit committee should have at least one person who is having a recent financial knowledge. And if they are of a sale and production related, mean financial knowledge is lacking. There should be at least one person who is having recent financial knowledge, means finance qualified, either chartered accountant, ACCA, or any finance knowledge. So they should appoint at least one non-executive director having finance knowledge. All of the directors have been members of board for at least 4 years. This means after 3 years, they are not reappointed. As the chairman does not have an executive role, he has the sole responsible for liaison with the shareholder and answering their questions. Not only chairman, all directors should be accountable, answerable for shareholder, not only chairman. The company has not established an internal audit function to monitor internal control, but it is not mandatory. If directors can monitor internal control by themselves, there is no need for internal auditor. If it is there, it's better. Okay, moving towards questions. Which of the following features are corporate governance deficiencies which Tangerine company would need to address prior to their listing? I mean, what they need to do to remove corporate governance deficiencies? The chairman has a sole responsible for liaising with the shareholder. No. What's the requirement? Which of the following features are corporate governance deficiencies which a Tangerine company would need to address prior to the listing? So the chairman has a sole responsibility for liaison with shareholder. Yes, they need to address this because all directors should be responsible for shareholder. The company has not established an internal audit function. It is not mandatory. Not mandatory. The chair and one of the non-executive director are former executive director of Tangerine company. Yes, this is the issue they need to address. So which issues they need to address? 1 and 3. Me this option. Question number 12. The audit engagement partners review has identified the following additional corporate governance deficiencies. All the directors have been members of the board for at least 4 years. This was the issue. And they are not retiring after 3 years. The board is comprised of 6 executive and 4 non-executive directors. So these are the 2 main issues of corporate governance. What is the requirement? Which of the following would the audit engagement partner recommend to address these deficiencies to ensure compliance with corporate governance principles? If there are 6 executive of 4 non-executive, company should appoint at least 2 more non-executive directors, as well as company should maintain company should reappoint executive directors every 3 years. Sure. So what are the deficiencies recommendation? Number 1, the director should be subject to annual re-election. Annual re-election, yeah, after 3 years re-election. And for second, at least 50% of the board, excluding the chairman, must be comprised of non-executive directors whom the board consider to be independent. Is that fine? At least half directors should be non-executive directors, independent non-executive director, and directors should be subject to annual re-election. Some corporate governance code says directors should be reappointed every year. Some corporate governance codes like UK said directors should be reappointed every 3 years. So both are acceptable. What is the second? The directors must be reappointed annually by the chairman. Who appointed the directors? Shareholder, not chairman. This is wrong. At least 75% of the board must comprise non-executive director. No, at least 50%, not 75%. Next is again at least 75%. This means these 2 are wrong. Now we need to choose between 1 and 4. What is 4? The directors must be reappointed annually by the chairman. No. At least 50% of the board, excluding the chairman, must be comprised of non-executive director whom the board consider independent. This one is correct, but this one is not correct. So what is the best option? 1. Now moving towards question number 13. The audit engagement partner has assessed the makeup of the audit committee. I mean, there is no finance knowledge person. Which of the following would be valid conclusions from the assessment? It is acceptable for the chairman of the to chair the audit committee. No, company chairman and audit committee chairman should be separate non-executive directors. Company chairman cannot be chairman of any committee. One chairman of nomination committee can be a chairman of remuneration audit committee as well. But company chairman should not be the leader of mean chairman of committee. So this is wrong. What is true? A new member of the audit committee with relevant financial experience must be recruited. Yes, because this was lacking. So which one is a valid conclusion? Two only. Yeah. Number 14. The directors are aware that in accordance with corporate governance provisions, they have responsibility for internal control, implementation as well as review, but are unclear as to the extent of these responsibilities. Which of the following correctly describe their responsibilities? To review internal control annually, who's responsible? Directors. This means yes, yes, either two or four, not one or three. To report and on internal control to shareholder, no or yes? Yes. So which one is option D? Because they are responsible for implementing as well as reporting to shareholder after review. Number 15. The board of Tangerine is considering establishing an internal audit function. I mean, they have decided we should appoint internal auditor. Which of the following factors would be relevant in making this decision? Relevant factors for making this decision we need to identify. It would help the audit committee to discharge its responsibilities for monitoring internal control. The board would no longer need to take responsibility for prevention and detection of fraud and errors. No, they should implement internal control to prevent, detect fraud and errors. So this is not valid reason. The cost of establishing an internal audit function should be considered against the benefits gained. Yes, they should consider if internal auditor will provide benefit more than its cost mean is pay, then they should appoint internal auditor. Otherwise, they should review by themselves. Even this will be fine as well. Because if there is no internal auditor, who will monitor internal control, review internal control? Directors. Whose directors? Audit committee. If there is internal auditor, then audit committee will oversee, review other matters, not internal control, because internal control will be monitored by review by internal auditor. So option 1 and 3 are correct. Now we are moving towards question 25. For 60, oh my God. Okay, 25. The board has noted down a number of statements relating to the audit committee and has asked you to confirm whether their understanding is correct. Indicate whether the following statements are true or false. The audit committee should be made up of independent non-executive directors. Yes. Audit committee normally appoint the external auditor at the AGM. Who appoint the external auditor? Shareholder. They provide recommendation rather than appointing. The audit committee monitor and review the internal audit function. Yes, they monitor quality of work, independence of both internal and external auditor. The audit committee sets out the scope of the external auditor's work. No, external auditor work is decided by external auditor rather than audit committee. They set scope of internal audit work, not external auditor. They can set scope of work of internal auditor, not external auditor, because external auditor is third party independent. And for questions 26 to 30, we have a scenario. You are an audit manager in HTQ and company. One of your client SGCC has recently become a listed company and has asked for your advice regarding the changes they should make to achieve appropriate compliance with corporate governance codes. And there are some issues relating to corporate governance codes that you need to identify and provide recommendation. The board. Mr. Shafford is the chief executive officer and chairman of the company. This is the issue. Chairman and CEO should be separate person. If one person is having both position, his dominance will be there. His decision will not be challenged. What company should do? They should appoint another non-executive director as a chairman to separate the role. He appoints and maintain a board. Who appointing the board members? Chairman. No, there should be nomination committee who appoints the board members. And maintain a board of 5 executive and 2 non-executive directors. Board is not balanced. Company should appoint at least 3 new non-executive directors to balance the board. While the board sets performance target for the senior managers in the company, no formal targets are set for each directors and no review of board policies is carried out. If there is no review of board, mean financial strategies, financial policies, mean there is no audit committee. So they should make audit committee of non-executive director to review board policies. Board salaries are therefore set and paid by Mr. Shafford, mean chairman deciding the salaries. Who should decide the salaries? Independent non-executive director remuneration committee. This is also issue. Mean they should appoint remuneration committee of non-executive director. All the board members, including himself and not their actual performance, mean he is deciding his own pay as well. This is not independent. Internal controls in SGCC are monitored by the senior accountant. Senior accountant is working in the system and he is checking his own work. Who should monitor? Internal auditor or audit committee? Although the company assumed that an external auditor, your firm will carry out a detailed review of internal control. Is that external auditor work is to review internal control? No, its role is of internal auditor. External auditor role is to check financial statements rather than internal control. SGCC does not have an internal audit department or an audit committee. Internal audit department is not there, that's fine. But audit committee is a compulsory committee. If it is not there, this is big mistake, big weakness. Annual financial statements are produced providing detailed information on past performance only. No, there should be current as well as future performance mean forecast as well. So what are the questions? Requirement 1. Oh, sorry, question 26. From a review of information above, your audit assistance has highlighted some deficiencies in SGCC's corporate governance arrangements, especially in relation to the composition of the board. Which of the following actions would be appropriate to improve SGCC's corporate governance compliance? I mean, what should be the recommendation to overcome deficiencies of corporate governance? SGCC should appoint an external or consultant to review board policies. No, audit committee to review board policies rather than external consultant. SGCC should appoint a chief executive officer or board chairman. Obviously, to separate the role, they should appoint new person either as a chairman, either as a CEO. SGCC should create a remuneration committee to oversee the appointment of new directors. No, remuneration committee role is to define remuneration policy. Nomination committee should be there to appoint new directors. SGCC should implement a formal and rigorous evaluation of its director performance once every 2 years. SGCC should implement a formal and rigorous evaluation of its director's performance once every 2 years. They should implement a formal evaluation process, but every year, once every 2 years, it should be done every year. Even if it's saying every 2 years, we can say, okay, fine, because board performance is not monitored properly. So which of the following actions would be appropriate? If action, this one is right. If more, then 2. 27. Which of the following statement is correct with regard to composition of the board of SSG? SGCC should appoint 3 new non-executive directors to the board. There were 5 executive and how many non-executive? 2. At least 3. Not 3, at least 3. If there is any option of at least 3, that will be correct. If there is no, then we will make this correct. Number 2, SGCC should appoint 2 of its executive director as a non-executive director. No, they should not be employee of the company, even in last 5 years. SGCC should appoint 3 new executive directors to the board. No, there are already more. SGCC should appoint 3 of its executive directors as a non-executive director. No. So we can say 3. 28. Your audit assistant does not feel that SGCC's approach to internal control is sufficiently robust to comply with corporate governance principles and has drawn up a list of recommendations. Which 2 of the following recommendations are valid? Company should establish an audit committee with at least 4 directors as is required for all listed companies. No, at least 3 directors is required, not 4. Though there is no audit committee, they should appoint, but not 4, at least 3. SGCC must establish an internal audit department as it is required for all listed companies. No, it's not compulsory. The company has an audit committee and an internal audit department. The head of internal audit department should report to audit committee. Yes, this is accurate. They should appoint internal auditor and audit committee so that internal auditor should report to audit committee because audit committee monitor quality of work of internal auditor. SGCC should not rely on external audit to inform them of deficiencies in internal control. Obviously, who will identify deficiencies in internal control? Internal auditor rather than external auditor. So they should not rely on external auditor as the company was doing. So these 2 are accurate. This is relating to internal auditor. We will learn chapter 4 in relating to internal auditor. One more question left. 222. Okay, 222. X company is a listed company and has an audit committee. Identify by clicking on the relevant box in the table below whether each of the following statements is true or false. The audit committee's terms of reference should include, in their role should include reviewing and monitoring the external auditor's independence and objectivity. Objectivity means quality of work. Is that fine? The audit committee terms of reference should include appointing and removing the external auditor. No, they can make recommendation, but appoint, remove is of a shareholder role rather than directors, audit committee. The audit committee terms of reference should include evaluating and monitoring the effectiveness of the internal audit function. Yes. Just one more question, and then we will finish for today. There's a question in our notes. Okay. What we need to do from this question, write a letter to the board of a VP commenting on its corporate governance arrangement. We need to comment on corporate governance arrangements. Comment on corporate governance arrangements mean we need to find corporate governance deficiencies, and we need to provide recommendation how those deficiencies can be overcome. Can you identify corporate governance deficiencies from this question, please, by yourself? Everybody, please. Try to identify corporate governance deficiencies from this question. There are 8 to 10 weaknesses. Except this, we have covered kit questions 65, 11, 12, 13, 14, 25, 26, 27, 28, and triple two. Okay. Van Persie PLC is a small listed company in the retail industry. It owns 150 retail stores and has been its turnover and number of stores increased rapidly over the last 4 years. The managing director's Arsene Vander has been at the helm for 5 years. Managing director means CEO is with the company for over 5 years. So there is one weakness. Might be he is not reappointed every 3 years. So the company should reappoint executive directors, including CEO, every 3 years. And has turned the company around from being an unfashionable underperformer into a key UK brand whose products are experiencing strong demand. So there is one weakness. Arsene Vander has a majority shareholding in VP. This person is a shareholder as well and has a reputation for taking high risk, both personally and in business. Though he is not non-executive director, he is a CEO. CEO might having shareholding, but non-executive director should not be having shareholding. He is a dominating individual. He is dominating. This means he is having both chairman and CEO. So the company should avoid dominance of any individual. The board of six is effectively controlled by Arsene Vander, who is both chairman and CEO. So this is the issue. Company should appoint another non-executive director as a chairman. The 5 other directors are appointed by Arsene. No, there should be nomination committee for appointing directors. And comprise Susan Eddie Bayer, the finance director, Roger Roney, and the sales and marketing director, Gordon Blue, in charge of research and development projects, and 2 non-executive directors. 5 executive and 2 non-executive. So board is not balanced. Company should appoint at least 3 new non-executive to balance the board. Of whom one of whom is the ex-finance director. No, he is not independent, who has retired after many years of service to the company, and the other a long time family friend of Arsene. So both the non-executive directors are not independent, having close relationship with the executive as well as employee in last 5 years. Arsene decide the remuneration of the other directors based on his assessment. No, there should be remuneration committee who should define remuneration policy rather than CEO himself. Arsene set performance target of Van Persie. Board meetings are held quarterly. No, it should be on regular basis rather than quarterly. Regular basis mean monthly basis. And are informal. No, it should be formal, largely led by Arsene. Verbal review. No, there should be minutes recording of the meetings should be formal. Van Persie is planning an extensive expansion scheme in Europe and the Far East through local acquisition, and to fund this expansion is planning to raise funds by issuing new shares by way of right issue. At the same time will borrow at favorable long term from major UK brands. So there is no issue relating to corporate governance. A major institutional investor. Institutional investors mean investor of the company. There are 2 types of investor for the company: shareholder and institutional investors. Shareholders are individual. Institutional investors are different companies like bank, insurance companies who invest their money into other companies. So a major institutional investor, Ferguson Investment Fund PLC, holding 9% of company's share, has written a letter to the board expressing their concern regarding the current board structure and cautioning the board regarding any acquisition plan. They have raised a concern, and directors should arrange a meeting with the investors to avoid their concern, to resolve their concern, to make them happy and satisfied. Ferguson is unhappy with the lack of risk committee. There is no risk committee. This means risk management strategy is not properly prepared. Business risks are not properly controlled. So they should appoint risk committee of executive and majority non-executive director, and with the limited role of internal auditor and audit committee. Arsene is dismissive of Ferguson and is unwilling to meet with the institutional investors. No, they should arrange a meeting to resolve their concern. And you have recently received a letter from Arsene requesting your comments. So what are the issues? First, directors are not reappointing every 5 years. He is a dominating individual. There shouldn't be any domination. Chairman and CEO are same person. There are five executive directors and three non-executive directors. Four issue. And non-executive directors are not independent. Fifth issue. Remuneration, there is no remuneration committee. Sixth issue. Board meetings are not held on regular basis. Seventh issue. Board meetings are not formal. Eighth issue. And he is not resolving the concern. Ninth issue. There is no risk committee. 10th issue. So we have covered chapter 1, chapter 2, chapter 3. Hopefully in next class, we will cover chapter 4 and 5 and we'll cover their questions from the kit. So see you in next class with something new.